Thank you for standing by and welcome to the Seplat Petroleum's Full Year Results 2015 conference call. At this time, all participants are in a listen-only mode. There will be a presentation followed by a question and answer session, at which time, if you wish to ask a question, you will need to press star 1 on your telephone. I must advise you that this conference is being recorded today, Thursday, the 24th of March 2016. I would now like to hand the conference over to your speaker today, Mr. Austin Avuru, CEO of Seplat Petroleum. Please go ahead.
Good morning all and welcome to this broadcast. It's our pleasure to give out our full year results for 2015. I'll handle the introduction, the general overview. Detailed operational performance will be handled by our COO, Stuart Connor, and the CFO, Roger Brown, will handle the financial details. In 2015, the fundamentals remain strong. Our long-term potential has been even now greatly enhanced. And 2016 started strongly. Working interest production was averaging 30,000 barrels of liquid per day and 130 million SCF, totaling the equivalent of 51,000 BOE per day until mid-February, when the Forcados terminal was shut in. Terminal remains shut in as we speak, and our production from our western assets, OMLs 438 and 41, the production from that axis is impacted by that shut-in. However, we're utilizing the water refinery, the pipeline access to the water refinery as additional storage capacity, and also to supply crude, specific export quality crude to the refinery, howbeit at about half of our full production volume. In other blocks, our production continues. In other blocks, I think the biggest piece of news is our gas production. Even with this shutting, our gas production continues into the domestic market, providing buyers with security of supply. And we have built-in resilience that has enabled us to continue to supply gas even with the export terminal down. We were further diversifying our production strategy, and that's a priority for us. I would dare say that 2016 will probably be the end of the transition into much more stable alternatives for diversifying our export of crude oil. Gas revenues were up 200% in 2015. As you know, by the end of May, we had commissioned our gas expansion project in Oben, and through the year, that plant ran smoothly, giving us a full year gas revenue is 200% higher than it was the previous year. And that continues in 2016. And in fact, by the end of 2016, we'll have further expansion of that gas plant, and you start seeing the full impact of that in 2017. So really, where we are, after that step change from our production figures in gas, you will see another step change beginning 2017 when we commission the final expansion mode on our Oben gas plant. So we take all these into account. Our 2016 guidance will be 41,000 to 48,000 barrel equivalent. And our CapEx guidance will be about $130 million CapEx. But of course, as I said earlier, we'll have the flexibility to move this CapEx figure around a little up or a little down, depending on how we apply them into modest CapEx regimes that deliver the most value for us across our assets. The core fundamentals of the business have been strengthened. As I said, we have now strengthened our gas production and sales, gas production infrastructure and sales network to a point where it remains a major buffer in our overall business. And you're seeing a diversification of the geography of our asset basis, which will also be a further buffer against uncertainties in the West or for that matter in any part of the geography where we operate. So overall, I would say that the fundamentals have been strengthened. They look good, look much better than they have always been. We still have a few of these headwinds that we are fixing during 2016, but overall the future looks great. I'll invite Stuart Connor to give us the operations.
Thank you, Austin. Good morning. I'm going to talk a bit about our operations performance during 2015 and our work programme for 2016. In addition, I'll talk in some detail about our reserves and resources and the position of our gas business relative to the market. So moving on to slide 7, the track record of consistent production growth. Average working interest production for 2015, 43,372 barrels of oil equivalent per day, up 41% year on year and ahead of guidance. 74% uptime level in 2015. Reconciliation losses circa 12%. Excluding downtime for the impact of the terminal shutdown in early 2015, our working interest production was 47,537 barrels of oil equivalent. Full year guidance of 2016 that Austin already mentioned, between 41 and 48,000 barrels of oil equivalent per day, split between 23 to 28 range for oil and condensate, and 18 to 20 barrels of oil equivalent for gas. This guidance takes into account the current shut-in at Fragado's export system and is based on an overall uptime of around 67 to 70%. So moving over to slide 8, reserves and contingent resources as of the 31st of December 2015. Looking at the dial indicators, reserves and resources in million barrels of oil equivalent. 2P gas and oil reserves and resources of 480 million barrels of oil equivalent, up 200 million barrels of oil equivalent from the 31st of 2014. This is largely reflecting the reclassification of OMLs 53 and 55 as reserves, split approximately 56% gas and 44% oil. 70 million barrels of oil and condensate added from OMLs 53 and 55. 706 BCF of gas added from OMLs 53 and 55. Oil and condensate reserves life of about 20 years based on our current production levels. Gas life of around 35 years based on our current production levels. The scale of our gas reserves and resources underpins our gas strategy and allows us to enter into additional long-term supply contracts with greater certainty. So moving across to slide 9, the reserves movement year on year and contingent resources. Overall, 578 million barrels of oil equivalent 2P plus 2C, with 83% of that sitting in 2P. Our working interest 2P reserves are up 71% year on year, liquid reserves up 50%, gas reserves up 90%. We've grown reserves at OMLs 4, 38, 41 by 2C to 2P conversion and ongoing development activities and field performance. Reserves attributed to the acquisition of OML 53, 138 million barrels of oil equivalent, and OML 55, 47 barrels of oil equivalent booked for the first time. This has given us an organic reserve replacement ratio of 2 times production and 14 times taking into account inorganic volumes for the acquisitions. So moving on now to slide 10, the track record of consistent reserves growth from 2010 to 2015, which is a 6-year period in both oil and gas, through 2C to 2P conversion, largely on the western assets of OMLs 4, 38 and 41. Acquisitions, Pillar, OML 53 and 55. Compounded annual growth rate of 28% for both oil and gas, split 21% oil and 31% gas. It's moving Seplat from 141 million barrels of oil equivalent in 2010 to 480 million barrels of oil equivalent at the end of 2015, approximately a 6-year period. Moving into some of the details around the Pacific work programs, our western assets classified as OMLs 4, 38 and 41, and the pillar assets of OPL 283. Drilling and seismic, we completed 8 new development wells during 2015, consisting of 4 gas wells, 4 oil wells, and we also completed a workover in one of the oil fields. In 2016, we have a workover and convert Seplat 4 to a water disposal well, and we intend to drill and complete the Umaseti East well with our partners at Pillar. In addition, towards the year end of 2016, we'll start the process to acquire some 100 square kilometres of 3D seismic over the part of the Pillar assets. We also completed the storage tanks at Amukbe during 2015, where we now have 100,000 barrels of liquid storage that helps in periods of downtime. We completed the installation of phase 1, 3 times 10 million SCUF compressors at Oban to deal with the flare gas, and we intend to install a further 20 million SCUFs of AG compression at Oban during 2016, bringing AG compression capacity at Oban up to 50 million SCUFs per day. In Seplat, we've started a project to rehabilitate the existing gas plant with the refurbishment of the existing heat exchangers. And in Amukbe, we're about to install some electrohydrostatic treaters, where we'll be able to deliver from Amukbe export quality crude with very, very little, small percentage of water. Moving across now to slide 12, the Oban gas plant expansion project, which was the major project during 2015. You can see from the pictures that the installation and commissioning of the work was completed within a 5-month period. This takes the gross operated processing capacity of Seplat up to 300 million SCUFs per day, when taking into consideration the Oban plant at 240 and the Seplat plant at 60. During the year, we placed the order for an additional 225 million SCUFs of processing capacity in the form of 3 75 million SCUFs trains. The trains are now finished, and the GoEx works in the next 4 weeks, and we expect these to be installed later this year and operational by the end of 2016. If you look at the picture, you can see not only the plant, but you can see large areas to the right of it, and if you could see above, you would see that there's more space to expand this plant. This is where the compressors will go, the new booster compressors will go, and the new additional 225 million SCUFs per day facility. Looking at slide 13, talking more about the contracted capacity volumes, we see that demand for sales gas continues to outstrip available supply. Commercial pricing is starting to move beyond $3.50 per thousand. New and existing gas sales agreements such as the Azuro-Edo IPP, it's a power project, underpin investments to further upgrade the gas plant. And I'll show later on, when we look at some of the geography around this, that Seplat is strategically positioned to capitalise on the expanding gas market. When I look at some of the contracts in detail, as some of them we've shared with you in previous years, our domestic supply obligation remains unchanged at 130 million SCUFs per day for 10 years, commenced in 2012. We have 2 contracts now signed with NGC, that's Nigerian Gas Corporation, 100 million firm for 2 years, and a variable between 0 and 140 for 2 years. We have new gas and power projects for 116 and up to 200 million scuffs, all for between 5 and 15 years. And we have LPG extraction contracts for 10 years. So looking to the right-hand side now at the diagram, it shows predominantly the gas processing capacity of the company against the sales curves. You can see we're currently at 2016 at around 300 million, and we've been averaging 300 million for the first part of 2016 and the end of 2015. And you can see that we'll very shortly go up in 2017 to around about 430, 450 million with the new plant installed at Oban. So moving across now to slide 14, Nigeria's key domestic gas infrastructure today as of 2016. Significant on the western axis, you can see the infrastructure is fairly significant on the western axis and fairly minor on the eastern axis of the company. Amongst the volumes in the west, Seplat is a significant supplier at around 1/3 of the markets of Abuja and Lagos from our key hubs of Sapele and Oban. Moving on to slide 15, which talks about the planned future expansion of the domestic gas infrastructure. The domestic gas infrastructure will be extended to link the eastern gas resources with the markets of the west via the Obe to Oban gas link pipeline. Now you can see that pipeline in the middle of your graph. It's yellow and it's dotted. Planned to be installed during 2017 and perhaps 2018, and it will strategically link the gas from the east of Nigeria across to the markets of the west, where Seplat is well positioned to supply both the Abuja axis and the Lagos axis. The boxes show gross gas volumes in the assets operated by Seplat. Clearly you can see OML 53 at 1700 BCF of gross gas is significant alongside the gas of the existing assets of OMLs 4, 38 and 41 at approximately 2 TCF. Moving on to slide 16, OML 53. The background holds the producing Jasiki oil field and the undeveloped Alhaji South gas condensate and oil field, and the oil is produced through the Brass Export Terminal. Seplat is a designated operator partnering with NNPC. Adds an estimated 138 million barrels of oil equivalent of net working interest, recoverable reserves, 46 million barrels of oil and 533 BCF of gas. Seplat is strategically well positioned to monetize the large-scale gas and condensate volumes at Alhaji South and supply the domestic market, as illustrated in the previous slide. The next steps for OML 53, we plan to complete 2 previously drilled wells on Alhaji South oil as producers this year. We finalised the gas development projects and infrastructure requirements for the Asa North and Alhaji South, which is known as the ANOS gas project, which you'll hear about in subsequent years, subject to partner approval, and we'll target a multi-oil well and gas development campaign commencing in 2017. OML 55 holds 5 producing fields: Robert Kiri, Inda, Belima North, Idama and Joka, producing through the Shell Bonny terminal. Seplat is a designated operator partnering with NNPC. Adds approximately 47 million barrels of oil equivalent net working interest, 2P reserves, 17 million barrels of oil and 173 BCF of natural gas. All significant infrastructure and capacity exists on the block. The next steps to capitalise on quick-win production enhancement opportunities and optimise long-term development strategy. Initial focus on Idama and the Robert Kiri fields. Maintenance dredging facilities and wellhead access, and will formulate gas development plans for the 173 BCF. Just to close up now on the 2016 work programme, you'll see we've split it into 2. We have the drilling our planned drilling operations during 2016, and we have some of the major capital projects that are about to commence or about to finish. On the western assets of 4, 38 and 41, we currently have planned to do one water disposal well at Seplat 4. Work should start imminently. On OMLs 53, we plan to complete initial completion of the 2 Alhaji South oil wells and tie them into production by the year end. On the pillar assets, we have the Umeseti East 1 targeting 2 oil reservoirs and 1 gas reservoir. On the capital project sides, the green flags are all projects that we should finish this year. The crude quality upgrade by mid-year at Amukbe, the electrostatic heaters, the Alhaji South pipeline to connect the Alhaji wells of South 3 and 4 ST. We should install and commission and operate the additional 225 million SCF train at Oban. We hope to install booster compression at Oban, have that operational by the year end, and phase 2 of the Oban AG, where we'll install additional 2 compressors and water injection, pilot water injection scheme at Oban by the year end. New projects that will kick off, the Oban condensate tanks. We intend to kick off a project aimed at increasing our storage capacity at Oban by up to a further 100,000 barrels for both oil and condensate over the next 2 years. The Oban gas gathering is targeting bringing raw gas from the pillar assets up to Oban for processing. We aim to kick that off this year. And of course we aim to do the Ibuku 3D seismic with our partners Pillar and OPL 283. And this is all ahead of the possible appraisal well in 2017. So with that, I'll hand you over to Roger now, who'll talk about the finance.
Thanks, Stuart. Good morning, everyone. I'm just going to run through some of the financial highlights. If you turn to page 20. So just picking up with the revenue at the start, I mean, obviously you'd expect the revenues come off and largely driven by oil price falls, but obviously production has gone up year on year. So our revenue at 570 versus 775 last year. If you look through there, you can see that the gas sales really are starting to come in now, and it was $27 million last year and $77 million this year, and expect to see more gas sales obviously coming through in 2016. Some hedging revenues in there. Again, we've hedged. We hedged out last year 3.3 million barrels at $52 oil, and we've continued. We'll talk about it in the slide later on, but we've continued to hedge, and we're hedged through 2016 at 6 million barrels for 2016. So I'll get into that in the next couple of slides. Then working down through there, cost of sales, they've gone up compared to last year, predominantly because we had a one-off charge related to 2010 to 2014 for crude handling, which we reported in H1, so you'll have seen that before. And obviously DD&A, the depreciation has gone up because of the increase in the asset base. Translating to a gross profit of $249 million. If you look at G&A, within the G&A, you'll see in the financial reporting, you know, we include financing costs. So there's a one-off upfront costs in the $1 billion refinancing. We split this out separately here for you, and looking at G&A, $97 million versus $140 million last year. Now, the one last year obviously had a number of the IPO costs through it. Then we get down to we have you know, obviously we've come out of Pioneer at the end of 2015. We've made an application into NIPC for the 2-year extension. We await the results of that. So in recognition of there's no decision yet, we've just put through a deferred tax charge, which is of $21 million. We would expect that to reverse going into deferred tax asset going forward. And then going down through the other main lines, operating profit 158. Financing costs are really kicking in now in 2015, and therefore we had a profit before tax of 87 and a profit after tax of 67. So, you know, in these tough times with oil prices and impairments, etc., you know, we're reporting a profit here of 67, albeit, you know, quite significantly down than last year. CapEx incurred was reduced by about half, and it shows the flexibility of our capital programs that we're able to cut back. And you'll see earlier on we said that our guidance for 2016 is going to be about 130. So we'll pick up in another slide. Cash flow before working capital of 190. Net debt has slightly gone up on last year. That hides a bit because in January and February we had an inflow of cash from our partner MPDC of about $150 million. So those cash balances are a bit lower at the year end. And obviously we reported before that we had the $1 billion refinancing. So turning to page 21, we'll just reconcile where we went on the cash flow. A number of these block bars you'll have seen before in previous reporting. We obviously had the return of the deposit from escrow, and then obviously the refinancing at $313 million of net proceeds. Then you see, you know, the actual cash on capex, a PP&E of 122. That was against 152, so some accruals there. Loan repayments, if you combine the principal and the interest, you've got in excess of $200 million of loan repayments. You're starting to see the impact in the cash flow of that. Dividend, you know, we obviously paid the dividend of 72, and then the back end of that chart showing the 373. That was the Chevron acquisition reported in Q1, and we note that we cleared the court case on the Chevron assets in January 2016. So therefore, the year-end balance of 326 on cash. Turning on to page 22, we further break down our capex over that past couple of years, and you can see the impact of the reduction in capex. Interestingly, you know, really the big decreases is on the drilling side of the program, which Stuart outlined. The green box is obviously what we're spending on a gas project, so there's quite a significant investment going in on gas, and that really is quite significant for us. You know, the gas prices are delinked to oil prices, so therefore it's a good hedge against these low oil prices. So we're 152 million of capex in 2015, and then we're guiding now at 130 million. The bulk of that being in facilities and gas projects, with only $20 million projected in drilling costs. Turning to page 23, something that we've been very focused on, obviously, is this receivables balance, and we're pleased to report that it's decreasing from quite sizable levels. So we had $463 million of receivable. And then that then translates to a headline receivable at year-end of 491 after we offset some of the gas revenues we've received, which is the government share of the gas. We are continuing to offset crude handling charges against the balance, and therefore the net receivable reported is 435, with 111 million of offsets between the gas revenues and crude handling. Post-period end, we had another $150 million received in, so that has reduced further. There's been some charges, but you know, the net receivable as of yesterday was $350 million. We continue to work closely with government. We were hoping to put in place the JV loan receivable financing. Significant work has been achieved and completed on the documentation, the loan. That sits with government at the minute for approval. So we're disappointed we didn't get it in the end of last year, but I would say it's the first time NPDC has done this, so it's not an easy thing to achieve, but we continue to make good progress at the top level of government. So now turning on to page 24, just a little bit about the capital structure. You know, obviously we had the $1 billion refinancing in January last year, which reported significantly. These balances, we've serviced principal on the 7-year facility, and we started servicing the $300 million revolver at the end of last year. So those balances are coming down. We report here, you know, a loan that sits at Belém Oil as a subsidiary at $36 million, and we'll look to restructure that now that we've just we can move ahead with OML 55. Cash and cash equivalents of 326, and then reported net debt of 573. On the hedging side of things, say a little bit about that. Obviously, 4.4 million barrels we did at, in 2015. 2016, we hedged at the back end of last year 3.3 million barrels for H1 at 45, and recently we've just gone in and extended into H2 at 2.7 million barrels at 40. So we have 6 million barrels protected for this year at an average price of around just below $43 a barrel, as we continue to monitor. And our hedging program is a constant one, and we monitor rather frequently. So if I turn on to page 25, just to summarize, you know, obviously our revenues have been impacted in H1 with 35% downtime, but much more improved in H2 at 6%. And obviously with the Forcados shutdown, as Austin picked up, you know, we are looking at alternatives around that. Gas revenues are coming in more prevalent, and we're 14% off the 2015 revenues compared to 3% last year. And gas revenues are clearly linked to oil price. Our flexibility of our work program resulted in we took the capex down by half, and you'll see we'll continue to bring that down in 16. But to the extent we get an improvement in oil price, we can then you know, dial up the capex and increase it. Receivable is going in the right direction, and it's reducing, but we still take it very seriously. It's down to manageable levels. Net debt at 573, but 115 million received post-period end. And then in terms of our dividend policy, we paid 4 cents interim dividend, and Seplat is a dividend-paying company, so we have continued to maintain that, and we decided that the board is going to recommend the 4 cents a share final dividend, bringing the year's total to 8 cents. So just to pick up the final point, which is our strategy continues to be driven by focusing cash generation and really being very selective on our portfolio and prioritising that cash into capital projects that will give us the highest return in terms of cash flow and also profitability. So thank you for listening, and that completes the presentation, and I will now hand it back over for Q&A.
Thank you. As a reminder, if you would like to ask a question, please press star and 1 on your telephone and wait for your name to be announced. If you wish to cancel that request, please press the hash key. Once again, it's star and 1 if you would like to ask a telephone question. Your first question comes from the line of Femi Aderoha from Renaissance Capital. Please go ahead.
Hello, good morning. Thanks for taking this call. My first question really is just the 33% downtime for 2016. Just wondering if that number is very conservative, and why guidance in oil production is reduced for 2016. Based on our model, we're seeing 120 downtime day for 2016 going to affect earnings significantly. So I just want to know your feedback on that. My second question really is on the gas price. It was 2.5 for 2016. Where do you see the gas price staying in 2016? Thank you.
Okay, our guidance in 2016, yeah, as you said, recognizes 33% downtime, and that's largely because what is happening right now that we're built into it. Our production guidance takes into account our production from across our assets, our ability to continuously produce gas, even when the export pipeline is down. So when you work all the numbers, and also our ability to also modestly increase production during the period that the facilities are back on production. If you look at 2015, in spite of about 30% downtime in 2015, you will see that our actual production versus our projected budget production, the difference was just about 8 or 9%. Part of this is our ability, when the facility comes back into operation, our ability to play catch-up. There are things we can do, both our gas and oil production, to try and catch up for lost time. So, yeah, even though we have such a high number of days of downtime projected, our actual production guidance has taken into account all of that. Yeah, the question on the gas price, we are budgeting around $3 in 20. That's aggregate price about $3 in 2016. And going forward, our aggregate gas price, we see it staying in that $3 to $3.50 range going forward. So we think we have substantially moved across from what we call the transition period, starting 4 years ago, from 20 cents to a price range in the bracket of $3 to $3.50 going forward. That is the aggregate between our domestic supply obligation and our commercial sales. We think it will be in the $3 range in 2016.
Your next question comes from the line of Mijibuski Obika. Please go ahead.
Hi, good morning. Thanks for the presentation. I have two questions. First of all, could you give us a sense of how many days of downtime you suffered in 2016 so far? And you also give us more color in the Transforgados pipeline. How many days have you been shut down so far, and how much progress have you made in reopening that pipeline? Then my second question has to do with your pioneer tax discussion. Your in-house, what amount of tax payment are you projecting if pioneer tax extension is refused versus if it's granted? So what are you estimating now?
Okay. Tax element, tax estimation for 2016 will be handled by Roger. And by the way, you know, our in-house calculation assumes that we don't get the extension. So Roger will handle that figure. So far, the actual Transforgados pipeline downtown to date is only 8 days. It's just 8 days to date. The current crisis we have is not really the Transforgados. It's the loading arm, the loading pipeline from the terminal to the loading bay to the SBM offshore. But otherwise, the Transforgados, which has always been the hotbed of crisis, we've only suffered 8 days to date. Our estimation to the end of April, we would have suffered 53 days to the end of April. That's our estimation when you combine the 8 days of Transforgados and what we're seeing now on the loading arm as our estimation to the end of April.
Sorry, the 53 days, is it including aside the Transforgados?
Yeah, the Transforgados has been down for only 8 days. Right now, as we speak, the Transforgados, there's nothing wrong with the Transforgados. We're estimating, or we're projecting that the loading arm will be down through the end of April. So our estimation, not to date, but to the end of April this year, is that we would have suffered 53 days of downtime.
Okay, I'm going to pick up on the Pioneer discussion. So, as Austin said, we plan for no Pioneer extension in our budgeting. When you actually look at the likely 2016 charge around Pioneer, a couple of factors come into it. One is that we have actually a tax credit sitting in our accounts from tax we paid in 2013, so we carry that forward, and then we have got significant capital allowances, qualifying capital allowances against it. So we are really forecasting these low oil prices, very low 2016 charge, if any charge on the oil side of things. So there may be some small tax charges on the gas side. In 2017, it largely really depends on where oil prices go, but low oil price environments, it's actually quite a minimal charge going through the accounts. So that, and then obviously discussions are ongoing with NIPC in terms of that extension.
Thanks.
Your next question comes from the line of Al Stanton from RBC. Please.
Yes, good morning, folks. Two questions. Same one as the first one's the same one as everyone else's, I'm afraid. In terms of downtime, is there any potential impact on the gas production? I get that there is additional storage, but I don't know the condensate yield. So in terms of 2 times 50,000 barrels a day, is there any threat that if, let's say, you can't export oil through May, would that start to impact on gas sales, gas production?
We have put in we've actually bent over backwards to sustain gas production during this downtime. In addition to our 100,000 barrel storage capacity, we're getting additional storage capacity that could be in excess of 300,000 barrels from the refinery. The refinery, it's going to provide us an outlet, and we've worked out those details. That's really where the pipeline were done to the refinery has come in. So we met with government, and everybody is treating this, especially the gas supplier, almost as a national emergency. And so we have an outlet through the refinery, and that's why in our projection we still believe that even with the prolonged downtime for crude oil export, we'll continue to produce gas.
Right, okay. And then the second question is probably for Roger. In terms of the debt repayment or amortization schedule, if you're including a bit of capex growth in 16-17, perhaps you're paying taxes as well. Are you quite comfortable with the debt repayment schedule, or is the receivable loan that you talked about the key to shoring up the balance sheet?
Yeah, thanks, Al. In our plans, obviously, this receivable it coming down is very critical to do that. The government has continued to allocate a sizable portion of the oil revenues to bring that down, and that's why you see it coming down in our results. And if the money had been received prior to the year end, you'd have seen a lot less on the receivable. So it is essential that the government continues to meet its cash calls and aims to bring down that receivable. Putting the JV loan in place, and significant work has been done on this. So getting that in place will obviously bring in an upfront amount of money, which will assist as well. The gas revenues coming in are critical as well in terms of that. So look, we manage very carefully our cash flow. Given that we do have sizable debt servicing, we are comfortable we've been working with our banks, and our banks have got comfortable with our projections and our profiles and everything else to service that. So we haven't suffered any acceleration on the loans from our lenders.
Right. Cool. Thank you.
Your next question comes from the line of Michael Alsford of Citigroup. Please go ahead.
Yeah, thanks for taking my question. So I just want to follow up on Pioneer. Firstly, you're providing that you're going to be paying tax or a little bit of tax in 16, and you don't think you'll get it extended. I just wanted to get a sense as to whether that's effectively an informal view that you've been provided with from the government, or that's just being very prudent from an accounting perspective? I'm just trying to get a sense as to how likely is it? Is it being, we're going to get a rubber stamp that you don't get it in a week's time, or is it actually just more a prudent accounting treatment on the Pioneer tax? That's my first question. And then just secondly, I guess one of the success stories of the company's been around its ability to build strong relationships with the local communities where you operate. Now, clearly, with the taking over of the 53 and 55 assets, they're in different areas of the Niger Delta, arguably in more challenging operational areas near and around Port Harcourt. So I was just wondering whether you could provide a little bit more colour and clarity as to how, I guess, those relationships are being built, what operational procedures and measures you're putting in place to, I guess, operate those assets going forwards. That would be really helpful. Thank you.
Thank you. If you recall, even when we were discussing the third year result, we also insisted on this level of prudence in treating the Pioneer. We had always taken a worst-case scenario that if we don't get the extension, this is what it will be. We haven't got any official response from government saying that it will not be rolled over for 2 years, but we'll continue to be prudent. And again, as Roger said, fortunately, the way the Pioneer has worked, there's very little difference, really, as you can see, between rolling it over for 2 years, a combination of very low prices and therefore very, very little projected net profit to tax, and the considerable capital allowances we have and tax credits that are rolling over really makes very, very little difference to our operations in 2016 and 2017. And we've decided to be prudent by assuming that it doesn't get rolled over. One of the things we haven't discussed, and we don't also bring it into our calculations, is if finally we get notification that is not rolled over, part of our gas expansion going forward will on its own automatically qualify for some level of tax relief on the gas side. That's already that's well documented. So, overall, our tax burden for 2016 and 2017, we think that is significant enough to make very little difference between having Pioneer and not having Pioneer. Yes, you're right. Our relationship with our communities, that continues to be one of our key elements of our success. And the fundamentals are the same even when we go to the east. As a matter of fact, we think OML 53 is even a much more quiet environment than where we're operating in the west. OML 55 is the one in the swamp, and it's also part of the reason that our partner in OML 55 is Belema Oil, that is essentially with substantial shareholdings from some of the community leaders in that area. So we think that will be just as successful both in OML 55 and OML 53 as we have been in the western assets in terms of community relations. In fact, as we speak, we've already had our first level of engagements with the communities in OML 53, and already understand that we're here, and we're working on those relationships and transferring our experiences from the west into those assets. So fundamentally, we do not expect any difference between what we have seen in the past 5 years and what we expect to see going forward.
Okay, thanks very much.
Your next question comes from the line of Ildar Vavlet from Renaissance Capital. Please go ahead.
Oh, yes, good morning. Thank you. So I have two questions, and one still on the downtime and your guidance, which comes at about 120 days of full downtime. If I got you right that you will have 33, your expectation is 33 days of downtime by the end of April, it means you still potentially provision for another 87 more days. And I just want to understand, is it due to how you expect the current, as you call, crisis to unfold, or you just provision the contingencies for unexpected, unbudgeted downtime in the second half at some point, or is it more really that you anticipate that the current shut-in operations will carry on like this for another 2 or 3 months? That's my first question. And the second, on the Pioneer status, any guidance on when you expect, to hear back from the government? I mean, I understand it's a very delicate topic, but, Is it going to be second half, mid-year? And specifically, are you paying petroleum profit tax now because the pioneer status has expired, or you are not paying and you're just waiting? So, and is there a risk that the government will actually impose the fines because PPT has pioneer status has expired, if you're not paying, that creates a risk that you should be paying and you're not. So, can you just provide some clarity here as well? Thanks.
Okay, if I take the first one on the pipeline or the downtime, it's not 33, it's 53, 53. And
right.
As it's early into the year, we're being prudent for the second half of the year. We're making an allowance of potential additional disruption based on previous years.
But that figure, we'll review that figure at the end of H1. At this point, taking this early hammering, it's only proper to be this prudent. When we go through this phase, through the first and second quarters, by the end of the second quarter, we will revise the guidance particularly on the pipeline outage. But today, this is how prudent we want to be.
I'll pick up the Pioneer. So in terms of when we're likely to hear, obviously we started this process last year with government, so we can't accurately predict when we're going to hear around this, but there's constant dialogue with the government. So we continue as if we are out of Pioneer period. What we've done is we've already put forward a preliminary 2016 calculation on tax. We do not expect to be paying tax into government, and anyway, the way it works is that there's a projected tax rate for 16, and then you do a shore up in 17. So we continue to progress. We file those tax returns as we've always done with the FIRS, which is the Inland Revenue Service, and we are not projecting a significant tax charge in 16, which is why we're not paying significant tax at the minute.
Okay, thank you.
Your next question comes from the line of Alex Topo from Exane. Please go ahead.
Hi there. This is Alex Topozoglu from Exane BNP Paribas. Thanks for taking my questions. You talked a bit about the forward work programs and building community relations on OMLs 53 and 55. So I was wondering if you could provide a little bit more detail on the capital that you're going to allocate to those blocks, and also how do you see production evolving on those blocks now that you've been able to secure them? Thanks.
Yeah, if you look at the work program that Stuart presented,
page 18.
That's on page 18. You will see that we're going in. We're doing 2 wells in OML 53. It's our projection, and 1 well with our partners in the Pillar asset. So we are not booking additional production during 2016 for those efforts, but by the end of the year and certainly through 2017, you'll then start seeing the results of those efforts. So and this 3-well program could actually expand to 6 wells, depending on how prices evolve and how the year moves on. So again, in our guidance, we are being prudent, and most of this work that you're seeing, as you can see, these wells, we start doing them actually in the second half, July through September. So the results will come in at best in Q4, but certainly the results will show up quite clearly in 2017. So to be clear on your question, starting January 2017, you'll begin to see some production increases in these new assets that were acquired, both in 55. Even in 55, where you're not seeing significant capex, as the CEO pointed out, we do some very low capex maintenance activities that will maintain a certain minimum level of production from 55. So by the end of the year, the combination of 55 and 53 will start making contributions, fairly significant contributions to our liquids production. additional gas production you will expect from the east, which will come from 53. That is still about 3 years away. That's the ANOS project. It's a major unitized project that when it kicks in, starting from 2019 through 2021, when we ramp up, those volumes will be quite significant.
So, thanks. So just to be clear, so when you acquired those blocks, they were a little while ago now, I guess, but they were producing, OML 53 was about 2,000 barrels per day. I mean, you've given some update stints, but there was extensive capacity on those blocks. But it was just a question of, like you say, doing those quick wins and production enhancements. When we go into 17, you said we can start seeing that contribution. Are we looking at a doubling, tripling? Are we looking at more of a 2018 event until the contribution becomes material? Just trying to get a sense of the actual, growth opportunity from these ones. Thanks.
You know from quarter to quarter we'll give you clear figures. But as I said, you see contribution from 2 wells from OML 53, in addition to maintaining the 2,000 to 3,000 gross production that is already there. Yep. We will do the maintenance that will at least keep OML 55 production no less than where it is at gross of somewhere anywhere between 8,000 and 12,000. So if you work those numbers up and also work up some gross of 3,000 from Pillar, you will see that in 2017, yes, there will be fairly significant contribution from the east. But again, as we move forward, when we do all this work by Q3, we would have done these wells and tested them, and then we can give you clear figures. We'll not be shy of giving you the exact figures.
Okay, so we can expect like a presentation, something to outline the growth on those 2 blocks, given that there hasn't been a huge amount of detail in the past pending the court case and everything else.
That's right. The full impact of the Supreme Court vacating the injunction is that we're now able to design a work program, have it for our own purpose, a low capex work program, and therefore we can see increases in production, which we'll never have seen because we're not able to move in and actually do any work. So what you're seeing for the first time is that we have now, gone in to design work programs that we can implement. And these will continue to change. If oil prices firm up a little better, you can see a much more aggressive work program, particularly in OML 53, in addition to what we have. So the key message is that we have moved into those assets now physically, and we are now able to execute work programs that fit into our overall corporate work program to maintain production guidance as we get that.
Great, that's really useful. And maybe just just a small thing on that loan documentation. You say final loan documentations with NPDC. How close do you expect a green light on that front?
All I can say is there's been a lot of work done, right? So that means it's going to need top level approval in government. So it's with them. It's been with them for a while. So we're hopeful. We can't really put a date around it, but we're making some good progress.
So overall, we have included in our overall full year calculations. So it will happen, and it will be part of our full year calculations for 2016.
Brilliant. Thank you very much, guys.
Your next question comes from the line of Owen Thomas from Nomura. Please go ahead.
Morning, guys. So just to follow up on the production outlook, can I just ask a little bit about the state of the Warri refinery and how much exports that's actually being utilized by the refinery itself? And then just a second question on the gas outlook. What's the government doing to incentivize gas power growth over the next 2 to 3 years? I know they have a target of around 20 gigawatts, but what's in build at the moment, and where do you come in, and how do you expect that to affect your gas output over the next 3 to 5 years?
Well, gas to power today, it's about 900 million scf a day. Is what is supplied to fire the current power plants. The requirement by the end of this year, actually, those power plants will be needing at least 1.7 BCF of gas a day. Currently, we supply a third of that 900 million scof, and as you also listened in the presentation, that capacity to process gas will be at a little over 500 million scof at the end of the year. And so, our aggressive gas expansion program, it's based on what we see in terms of gas to power requirement. That even if we're doing 500 million scof at the end of the year, it will only still be less than 1/3 of the total requirement if you look at the government projections. And this is based on actual gas, power plants that have been built that don't have sufficient gas supply today, as well as those under construction that will come into operation during 2017, 2018. So the projections for gas to power that I give you about 1.7 BCF per day at the end of the year, growing closer to 3 BCF by the end of 2019. Those are figures that are very realistic. So within that context, even if we're doing 500, 600 million scof a day at the end of next year, we're still just struggling to deliver 25%, 30% of the total requirement. So you can understand, therefore, why our gas program is quite aggressive, because domestic demand is tripling by the day. What was your second question?
How much?
Oh, the refinery, yes. We can deliver 30,000 barrels a day to the refinery when they resume full processing. So the refinery, in spite of the bureaucracy that comes with it, provides us solutions, or two lines of solutions. The refinery can provide us additional 300 or 350,000 barrels of storage, even if they are not processing. When they are processing, we can deliver to them spec of 30,000 barrels a day on a continuous basis. But again, as I said, we are working on so many alternatives that by the end of this year, we think that we'll be in a position where no matter what happens anywhere, at least half of our production will be going.
Okay, thanks very much for that. Could I just follow up? Could you just give a general picture of the overall security situation in the Delta from the west and your eastern fields at the moment, given the low oil prices?
Everybody remains fairly nervous about the security situation. What I can say is that I think for the first time in a few years, it's being handled as a national priority. Because particularly at these low oil prices and reduced revenue to government, any outage in production, it's a double whammy for government. So we are hopeful. We are hopeful that overall across the Niger Delta, we will have a solution that provides us much better stability in export pipelines. We are hoping that when we'll be discussing 2017, we will not be making provision for 1/3 of the year being out. We should go back to the normal 10%, 35 days a year that was the case in 2012 and 2013.
Okay, thanks very much. Just one last one. In your production guidance, what assumptions are you making for reconciliation losses?
Our guidance is gross, so it doesn't factor in reconciliation losses, but we would expect reconciliation losses to be consistent from prior years.
Okay, great. That's perfect. Thank you very much.
Your next question comes from the line of Sayer Sayestin from Chapel Hill Denham. Please go ahead.
Hello, thank you for taking this call. My question is around your recent, it's actually been answered partly, but it's more about around the pioneer taxes and also around your OML 5355. I think I must have missed the response around that because my line got cut off. Are you looking to start to have production from those wells in 2016 going into the future? Thank you.
53, 55, yes. The answer is yes. Not just having production. We've actually physically moved in, so we're able to plan further development, howbeit low capex development for now, and that's why in our operations guidance, We have 2 wells in the second half of the year for OML 53, and 1 well for the pillar asset. So to answer your question directly, not only are we getting production, we actually plan to enhance production from those assets going forward.
Okay.
We've given a lot of explanation on what we said.
Yes, you have.
We're being prudent and making the assumption that we don't get the 2-year rollover, and so we are making our computations for tax in 2016. But because of what gross revenues are today and the substantial capital allowances that we still have, we're seeing the tax figures being very negligible so far.
Okay, thank you. One more question, quickly. Just one more question. I was going to ask you a question regarding your the probable change in the structure of the JV relationship, especially considering the high level of receivables from the NNPC. So do you see any potential change in the structure of the JV, looking to have the JVs have much larger or more controlling interest in those assets?
These 2 assets, our JV partner this time is actually NAPIMS and NPC. So we're going to have 2 lines of relationship. Our current existing assets, our relationship is with NPDC, where, as we said earlier, the CFO highlighted how we've finally got a grasp of the receivables and it's heading south. And we think really that the receivable situation, even with NPDC, will increase considerably before the end of this year, and you see very substantial reduction. If you look at the figure it gave to you, at the end of the year it was 436, but actually as at yesterday it was $350 million. In our relationship now, with all the learnings from this build-up of receivable, remember the history of these receivables were very, very aggressive in our capex in 2013, 2014, and part of 2012, and NPDC and the partners simply didn't catch up in payments. That's really how it built up. So with those learnings, going into these new assets and our relationship with NAPIMS, we will not build up any high capex program unless we're very, very certain that the funding is in place on all fronts. If we build an aggressive capex program, which obviously will not be this year, but any time in the future, it can only be that we have reached clear agreement with NAPIMS on the funding, either that their funding is in place or that we agree a modified carry. But one way or the other, the funding will be certain before we embark on any aggressive capex going forward.
All right, thank you very much.
Your final question comes from the line of NWC Obika from Stanbic. Please go ahead.
Hello, good morning. I have some follow-up questions. My first question, I want to confirm if the current arrangement you have with NPDC as regards to your outstanding receivables is any way tied to your ability to source the 300 million joint loan facility, such that if for any reason you're not able to source it, it will affect the existing agreement. That's one. The second one, I just want to confirm, I know you said a lot about OML 53, so should I assume that for 2016, working interest for both wells should remain at about 2,400 barrels of oil equivalent per day?
I'll pick up.
Yeah. So the joint loan, I think part of the issue is we keep calling it a loan. It's actually prepayment for crude oil allocation that is already going to NPDC's funding partners. So really, what the CFO was explaining is a mechanism for monetizing those volumes that have been allocated to recover this cost. Are you still there?
Yeah, I'm here.
Okay, so the elements, the variables that go into the workings of that JV loan, which really is prepayment for volumes that have already been allocated, those variables are already very well understood. The volumes that have been allocated are the volumes that we put into the calculation. So we do not see, that's why we don't see any risk, that's why we keep saying, but the CFO will give more details of that. 53 and 55, even as we speak, working interest production, it's about 5,200 barrels a day anyway, right now as we speak. And we're capturing that from both 55 and 53. And that can only go up as we start to work the assets.
Just to add back to the loan, I mean, or the receivables funding, it's in executable form. So in terms of, there's any concern around not being able to raise the funding around that's already in place. So if the government can approve this and we can execute this receivables structure extremely quickly, and we're not concerned about being able to do that.
Thank you.
There are no further questions at this time. I'd now like to hand back to Austin Avuru, the CEO, for closing remarks.
Well, thank you very much, everybody. As we continue to say and highlight, if you see the full focus of our operations really is still about building a company with a solid balance sheet, a solid growth profile, consistent and sustainable growth profile. And you can see what we've done both from organic growth and growth by measured acquisition. We have consistently delivered, actually exceeded on our numbers. In spite of very, very strong headwinds that everybody is aware of, you can see that we've managed our operations, managed our finances in a manner that has positioned us to keep capitalizing on the growth opportunities that we see. In fact, further than this, we think that at the end of this very difficult industry situation in Nigeria, further opportunities will be thrown up, and we continue to glance over our shoulders and keep an eye on what those opportunities can be after this difficult period, and position our balance sheet to be able to maximize those opportunities when they come. So I think in spite of the headwinds, we see very, very bright days ahead. Thank you all very much.
That does conclude the conference for today. Thank you all for participating, and you may now all disconnect.